what we see in silver is the opposite of that right now. It's a 26-cent backwardation. We're back in backwardation again, which we saw remedied briefly by 50 million ounces sent to London. And all of a sudden, within a few days, backwardation started to rear its head again. They basically plugged a gaping hole with bubble gum and baling wire. I think it's going to get kind of interesting over the next 9-10 days. We'll see what happens, but I think it's going to be a huge delivery moment.
And I think that we need to see 100 before we see 1,076.
Well, let's do the math. If the geologic ratio right now is 7-1, let's put gold at 5,000 divided by 714. So if it's at it's got it, you're talking.
What if we go to Rickards?
Rickard says 24,000. That's the number he says gold will go to when revalued based upon, I think, the M2 money supply and gold that we supposedly own. Even if you divided that by 42, which is the average ratio between the two for the last 100 years, that's only 571. So yeah, you'd have to see a 12-to-1 ratio at 24,000. It's lofty, but I'll say this.
Welcome to Economic News, your go-to destination for all things economics and finance. Whether you're an experienced investor, an inquisitive student, or just someone who wants to stay ahead in today's ever-changing economic landscape, you've come to the right place. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, hit the like button, and send us super thanks if you find our daily recaps valuable. Enjoy the episode.
Interesting, right now gold is in contango. Contango is a normal market function where spot price is less than the futures price. Typically, when you're talking about any futures commodity price, you're paying for the storage, the interest expense, the cost of money. The further out you go, the higher the cost. So, you go out 2 years and the spot price may be 4,500, 4,600, whatever. The further out you go, the higher the price should be. That's normal. On the 28th of this month, in 9 days, those who hold long contracts have to declare, they don't have to, but they typically do on that first day, declare if they are going to roll it, cash it, or stand for delivery, right? So as you get closer to the delivery date, that spread will narrow and narrow and narrow to it should get even with spot, right? What we see in silver is the opposite of that right now. It's a 26-cent backwardation. We're back in backwardation again, which we saw remedied briefly by 50 million ounces sent to London. And all of a sudden, within a few days, backwardation started to rear its head again. They basically plugged a gaping hole with bubble gum and baling wire. And a 26-cent backwardation in the spot price, futures price, this close to futures expiration 9 days away, tells you that there's someone who wants silver right now, and there's tightness in the silver market. The leasing rates have come down, but last couple of weeks ago, they were as high as 100%, 200%, as we were $3 in backwardation. Speaking of extreme stress, now we're not there yet, but the fact that we're almost at the declaration point and we're in a backwardation tells you that there are big people, and the December contract's a biggie because it's delivery for both gold and silver. The fact that the gold market is saying everything's okay, I guess. The silver market's saying not so much. There's not enough supply. There's more physical demand than there is bars to satisfy those contracts. I think it's going to get kind of interesting over the next 9-10 days. We'll see what happens, but I think it's going to be a huge delivery moment. Kind of like the U.S. Silver is now a critical mineral. China said, we agree with you, and we are going to limit exports to the point where every ounce that leaves China has to be permitted through Beijing. In other words, the government will say what goes, what doesn't go, and the free flow of silver, which China's a big exporter, a huge refiner, will put greater strain on the LBMA because they were one of the exchanges, the Shanghai Metals Exchange, that sent 20 or 30 million ounces to London at supposedly very high lease rates in order to plug that gaping hole with bubble gum. It obviously is leaking again. So we will see if China limits exports. And by the way, the U.S. calling it a critical mineral, all that metal that flowed back supposedly by tariffs, which it's not, they can just as easily limit or shut off exports out of the United States as well. The president can do it with the drop of a hat without congressional approval, and the fact that it has been labeled a critical mineral tells you it's now a matter of national security and of policy. So,
And of course, we're going to have to go out as a country and buy a stockpile because we ran out of all of our stockpile in 2020.
actually, the government has taken positions in 2 or 3 mining companies up in I think they're up in Vancouver in the Golden Triangle, or up in that area. You have now government stepping in the resource sector the same way they did with General Motors. It's a different thing, but whenever you put mix government with private enterprise, usually bad things happen. But nonetheless, it shows you that they are trying and taking very seriously the fact that it's about he or she who has the metals and the commodities wins. It's not just he who has the gold. It's obviously he who has the critical minerals. And one other thing, you look at China, not only do they produce the lion's share in the Eurasian continent of rare earths and critical minerals, but they're also probably they refine upwards ends of 95% of all of the world's critical minerals. We are lacking in so many ways, and looks like the government's now taking things seriously, including silver and platinum, not just the critical rare earths and the critical base metals that you would need to run a country efficiently. You can't be reliant on the rest of the world to provide that. When the chief investment officer of Morgan Stanley says sell half your bonds and buy 20% gold, when Michael Hartnett says, no, make it 25%, when Jeffrey Gundlach says 25% is not overweight, maybe, just maybe, some of these institutional people that these guys speak to, they don't speak to the public, they're speaking to the institutional traders, probably the ones that are bringing all the metal into COMEX. What if just a couple of them actually listened and started spending, 7-figure plus with dealers in the country here to buy this stuff like that? It's gone. And you've seen it. Tell people that and they're like, yeah, right, he's talking his book, but I'm not. This is an environment where such a small percentage of the public gets it. And if a little bit of the public wakes up at that level and starts to buy, it will drain this industry, which is a just-in-time industry where we normally will buy stuff months in advance from the mints. We know it's coming, but once, like the 2026 Silver Eagles, I sold 1,000 of them last night. So, we may have bought 100,000 Silver Eagles or more, 200,000. Yeah. By the time they get here in 3 weeks, we may only have 20 or 30,000 left.
Yeah, we had that conversation with our client who still has a fair amount in cash, who's done a lot of business with us, but still has some cash that she and her husband are looking to do something else with. It's making them very, very skittish holding it in the bank and being in the market. And, I think that they were looking at potentially a 75% silver, 25% gold allocation. It's becoming much, much more difficult, even after speaking to Matt. And if we wanted to do it in coin format, there is very little in terms of, backdate or random year sovereign coins.
Yeah, that's the first thing that disappears.
It's almost non-existent anymore.
And let's just talk about your client's fear for 1 second. Yep. The banking problems. That is the title, I think, of this podcast. Something is alarming me, and I don't say that lightly. You were here during the repo market crisis in 2019. No, you weren't. So you weren't here then.
I was in the financial industry.
Okay, so there was the repo market crisis, for those of you that remember, where the overnight lending rates went up to 10% in a very short period of time for the overnight repo market. You go back to 2008, we saw the same thing, a spike in the repo market before Lehman Brothers collapsed and the great financial crisis. In both instances, when the repo market collapsed, we were told it was an issue of lack of liquidity in the system. The banks didn't have enough money, so the Fed had to come in and inject money into the system in order to keep the plumbing going. Now, the repo market is where the biggest banks in the world and hedge funds, they trade with another overnight, literally overnight. And when you really don't hear about it very often, that's what you're supposed to do. It runs in the background. That means everything's okay. The plumbing of the system works. Over 5 days, 2 weeks ago, the Fed injected $125 billion into the repo market. That's a lot. That's crisis level intervention. That's the kind of intervention we saw in 2020. That's the kind of intervention we saw in 2019. And also in 2008. In a normal period of time, if there's a little market stress, maybe 5 billion is put into the repo market. In a high stress, maybe 10 billion. 125 billion is akin to turning on the water in your house. Every time, whichever faucet you turn on and whichever toilet you flush, you hear banging in the walls. You know something's not right with your plumbing. That's what this is. But the crazy thing about it is that this time, the banks have twice the liquidity they had in 2019 in the repo market crisis. They have enough cash. This isn't about we ain't got money problem. What this is about trust. You have the biggest banks in the world that are saying, you know what? I don't feel like lending money to you hedge fund or you regional bank, even overnight, because you know what? I don't think you'll actually be able to pay me back tomorrow. When you see that, the alarm bell should be going ding, 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 ding.
Yeah.
Because this is where problems show up before it does in the stock market, before it shows up in the credit market or CNBC or Fox.
Those are the breadcrumbs that you talk about.
These are the biggest traders in the planet who are saying, I would rather hang on to my money and leave it in a reserve account at the Fed than lend it back out to even to overnight to another institution because I don't trust their mortgage-backed security collateral, and I just don't think they'll be solvent enough to pay me back.
Yep.
I'm out. Very ominous. This isn't about liquidity, it's about trust. And you know what? Everything is about trust. The world kind of doesn't really trust our institutions, the Federal Reserve, the Justice Department,
Why would we?
The Supreme Court, the markets. And when you have a system based on trust,
I think that we need to witness 100 before we witness 176. Well, let's do the calculation. If the geological ratio right now is 7-to-1, let's place gold at 5,000 divided by 7. 714. So if it's at its gut, you're discussing if we advance to records, record indicates 24,000. That's the figure he states gold will rise to when reassessed based upon, I think, the M2 money supply and the gold that we supposedly possess. Even if you divided that by 42, which is the typical ratio between the two for the last 100 years, that's only 571. So yeah, you'd have to witness a 12-to-1 ratio at 24,000. It's ambitious, but I'll state this. The one thing absolute that I've learned, and there are very few absolutes in the world, particularly in finance. There are probabilities, but absolutes are scarce. The one absolute I have learned is that markets rise higher than anyone ever imagines possible to the upside, and downturns fall deeper to the downside than anyone imagines possible. When I began in 199, 1989, 1990, the Dow Jones was around 2,100, and the Nikkei was around 40,000. The Nikkei dropped all the way down to about 12,000 and just recently returned to where it was for a moment. I don't know what it's at now. I think it's below that figure, but it required a generation to get there. And at the same time, the Dow's risen from 2,000 to over 40. So, who would have ever thought it? Maybe. Who knows? In a world where gold and silver have been restrained to maintain the illusion of Western market dominance. As do I. But I think right now, with the ratio still being at that 78 to 82 ratio, I still think that you're going to be better off acquiring your silver today and exchanging it for gold at a later time. I think the football game is on here in the background. Monday Night Football. Let's use a football comparison. Tie game, one play left on the 5-yard line. You have to score a touchdown. You have this one play that's a guaranteed play. And almost every time you've executed it, you score. And that is what I would call the silver to gold ratio strategy. It's nearly a certainty. It's the best calculated speculation I've ever encountered. You obtain silver at 88-to-1, knowing it's emerging from the ground at 7-to-1 geologically, 16-to-1 geologically for 5,000 years. Now, it's diminishing, dropping to 7-to-1. It's vanishing, manipulated by the West to create this illusion of worthless silver to, I believe, uphold the military-industrial complex's requirement for silver. No one desires silver. Don't observe here. Not about price. It's about everyone grasping its true worth. U.S. government just did label it a critical mineral. China did too. The point of it is that it's significantly distorted because the West has restrained the paper price were 400 ounces for 100 paper contracts to every 1 ounce. That's going to cease. But even that one excellent play, you can mishandle, you can stumble, you can get intercepted. The issue with that ultimately could be, well, maybe gold, like the gold buffalo, you can't locate it. I still think it's probably the best trade of a generation, but it's not foolproof. And the worst thing is you end up with a bunch of silver, which in my view is a replacement for gold. Right now, at 88 ounces, historically 16, should be far less. Geologically, 7-1. So yes, but I'm never truly a supporter of going all in. Maybe place a little bit in gold and sort of dip your toe into 80/20ths, maybe. 70/30ths, 80, 70/30ths, 80/20ths. All right, let's get a couple more in, 3 more. I personally don't believe that we will witness $4 silver. I don't. I think it's certainly, every time we've witnessed the price drop to places where it shouldn't be, the reaction in the market is no, and premiums rise exponentially higher than the decline of the spot. Spot would fall by 10, premiums rise 12. Well, that's what I was going to state in terms of if you're seeking to wait, there's not much demand. It'll simply be consumed just like that. That's what I was going to, just like we observed back in March of 23, spot was only 18, 19, $20 around that time frame, but premiums on Eagles then surged to $20, $18 over spot. The major banks that restrain the paper price have to be saying, we get on the wrong side of this and we get a bunch of individuals saying, we want delivery. It's an existential threat. I don't think you'll witness it. And if you will, it will be a momentary dip. Load up the truck if you do, but I would say no. Well, look, we just observed in that severe downer several weeks back. We witnessed it drop from 53 and change down to 46. And just like that, we're back up to 54. Yep. Again, it's the things that you were stating back in the day that it was, silver was typically making that 20 cents, 40 cents moves. Then we began witnessing the one. Now we're witnessing $2 moves as far more frequent. So, when silver is $20, a $2 move is 10%. When it's $50, a $2 move is 4%. That's right. So, the higher you advance, these moves are startling people out dollar-wise. But consider the percentage. It's the same thing when people say the Dow Jones is down 400 points. Big deal. That's 1%. It's insignificant, right? So absolutely, think the larger the number, the more intimidating the percentage in dollar terms. But in truth, it shouldn't alarm you because it's the same percentage. Oh, I like this question. Mold. And I kind of on the heels of the other question, if someone goes all in on silver, hoping to trade for gold later when the ratio, not in the end. The message is clear. Silver and gold are entering a period of intense structural pressure, driven by distorted ratios, rising physical demand, export restrictions, institutional accumulation, and escalating stress within the global financial framework. With backwardation reappearing, inventories thinning, and confidence inside the banking system deteriorating, the setup for a major repricing, possibly triggered by December's delivery cycle, has seldom looked stronger. While nothing in markets is assured, the asymmetry in silver and the long-term case for holding physical metals have never been more persuasive. Do you think December's delivery month could be the trigger that finally reveals the physical shortage? With institutions shifting into gold, how rapidly do you believe retail buyers might feel the impact on available supply? If you appreciate the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. Furthermore, share your thoughts in the comment section. We value your support, and we thank you for being with us. Wait for the next updates.